Greetings. Today is Monday, June 2nd, and while we've seen a fairly impressive rally since that April 7th low, we need to be prepared for the other side of the trade. So we're always looking for evidence to see, is it possible that our conclusion is wrong? We're going to take a look at that today. On the screen right now is the S&P 500, and I'm trying to highlight the fact that from the top to this April 7th low was approximately 21%. This is also more evidence of the portfolio math that I spend so much time talking about, because the gain, the rally off of that low is actually greater than the decline, but we are still not back at those peaks. The thing that's really got me questioning whether or not we've drawn false conclusions is because over the weekend I'm studying and taking a look at our quant models, etc. And one of our quant models is still on a sell signal, and that's atypical. Usually there's a little bit of a difference between when the quant models fire their buy and their sell signals, but they're usually not this far apart. So the fact that one of our quant models is still on a technical sell signal gives me some additional pause. And so I want to take a look at some history to give you an example of when we might see some of these false rallies and we're lured into, say, a false sense of security. So let's take a look at 2022 as a simple example. Remember, 2022 was a pretty bad bear market. And in particular, what I want to highlight is the fact that we had about a 15% drawdown, but then the stock market rallied up about 12.5%. And in particular, this new high right here took out this high here. Generally speaking, when we see a rally that takes out a prior high, that is usually a bullish signal. Now, at the time, you can see that our VSI was giving us warning signs because our VSI was on a technical sell signal. Ultimately, the stock market went further down, and it was a bear market of almost about a 30% correction on the S&P 500. But the point that I'm trying to make is that even though we had a nice rally here in March of 2022 and it took out the February peaks, that was not enough to tell us that, hey, it's all clear and we can go back into the stock market in an aggressive fashion. This is why we use quant models. Now, in 2022, our VSI indicator was still very much on a red light. Right now, our VSI is indeed back on a buy signal, but our other quant model is not. And that is, again, that's giving us some pause. So if you're a client of ours, that's why we're still holding a fair amount of cash, because our quant model says that's what we should be doing right now. And again, that's why we use two different quant models. So let me give you two more reasons why you might want to remain a little cautious. On the screen is the S&P 500, but that's the cap-weighted version where the biggest stocks are going to have an outsized influence on the returns of the index. Let's instead look at the equal weight version where every stock in the index is given equal billing. What I really want you to see is that is pretty much still a negative trend. So there's this divergence between what the major index, the S&P 500, is saying and what is actually happening underneath the surface. If we break the S&P 500 down into the 11 different sectors, what two sectors are at the top of the performance list? We've got industrials and utilities. Those are two very defensive sectors. So the fact that they're at the top of the performance list is not very encouraging. What if we added precious metals to the list? Precious metals would take the top spot. So that is a very defensive posture that is leading the stock market. So these are, again, reasons for us to be a little bit cautious.